How's it going? I'm Andrew with Investors Hub and very excited to not be on camera for this video. We're doing a basics series called Options Trading for Beginners, and this is the first video where I'll be laying down the framework you need to know about options so you can properly understand what they are and maybe get an idea of what you're getting into. We'll also be giving away some free subscriptions to Investors Hub financial tools to commenters on this video, and I'll get into those details at the end. So do you like to make a whole crap ton of money and lose more than you ever gained because J-Pow tilted his head funny at a press conference? Then boy, do I have the time-sensitive financial instrument for you. Let me introduce you to the most addicting money multiplier of the finance market. Kicking it off, what is an options contract? Well, like I mentioned before, it's a time-sensitive financial instrument that magnifies the movement of the underlying stock that it's attached to. That magnification is why people purchase options contracts. A bundle of 100 shares gets tied up in some ribbon with a little bow on it. Then the gift giver puts a countdown clock on that bow. So the options writer surrenders the rights to the underlying assets to the options buyer, but not the ownership of the assets. That sounds odd, it's because it is. It's not an entirely intuitive subject, but hopefully it'll be less odd by the time we get done. The options contract begins its life as an idea in the head of the options writer, and it comes in two flavors, a call and a put. We'll start with calls because I think they're the easiest and because stonks only go up. Puts and calls are essentially the same, just pointing in opposite directions. So I own 100 shares of a company. We'll call them Company XYZ, and I decide I either want to hedge my portfolio or capitalize on unusual market volatility. Whatever the reason I come up with, what I'm thirsting after is that sweet premium. The premium is the opportunity cost to gamble, and the options writer is the house. Company XYZ is trading at $10 a share, and I write an options contract for 4 weeks out at a strike price of $12. The contract I'm writing is currently out of the money, meaning the current price of the underlying asset is outside the area where it would be profitable to exercise the contract. It is currently trading at beneath the strike price, and for calls, that means that the contract is out of the money. What I'm doing is announcing, "Hello world, I, Andrew, will sell the owner of this contract, XYZ Corporation, at $12 a share because I believe it will not reach that amount in 4 weeks. Would anyone like to take that bet? I will charge you $1 for the opportunity." My call is covered so long as I hold 100 shares of XYZ. I'll be able to fulfill the conditions of the contract. So somebody waddles along and agrees to the bet, hoping that the contract will be in the money before the contract expires, or at least closer to in the money and they can pass it on to another person. That $1 I mentioned is the premium I'm after, and it's not a dollar, it's $1 per share. $1 times 100 is $100. That's the cost of the contract. As a buyer, you'll see the price of the contract on a per share basis, but the actual cost is that number times 100. Okay, so now he's holding this call option. What does that mean for him? It means time is his enemy, and it's my friend. He has the right, but not the obligation, to purchase 100 shares of XYZ at $12 a share from the options writer. But the share price isn't at $12, it's at $10. Should he choose to exercise this contract, he'd be doing so at a loss because it'd be cheaper to just purchase the shares on the open market. In 4 weeks, this contract expires and is no longer valid. Despite the fact that this contract has no intrinsic value, it is solidly out of the money, it has what is called extrinsic value. The textbook definition of extrinsic value is the portion of the worth that has been assigned to an option by factors other than the underlying asset's price. Extrinsic value is like paying for the potential for greatness, the price of possibilities, and it's measured by the Greeks and by implied volatility, which we'll get into next video. If, say, the strike price of our contract was $8 instead of $12, it would have $2 of intrinsic value per share. Now, something very important to remember, this options contract that he purchased isn't stapled to his hand. He owns it and he could sell it to somebody else. Options contracts can and do get exchanged thousands of times before they expire, like a game of financial hot potato. Before we go too far down the rabbit hole, let's clarify what puts are. Puts are like calls, but instead of the options writer betting that the price won't go above a certain number, they're betting that the price won't go below a certain number. The value of a put option increases as the underlying share price goes down. If I wrote a put contract for the XYZ Corporation at the same strike price and time frame as the call we just referenced, so $12 in 4 weeks from now, I would be announcing that I, Andrew, hereby decree that the owner of this contract has the right to sell XYZ Corp shares to me at $12 each at a cost of $3 per share for that privilege, which is the premium. The price is $2 per share plus the extrinsic value of the contract to do so, because XYZ Corp is $10 per share right now, and $2 of intrinsic value gets baked into the option. In order to ensure that my put is properly covered, I would need to keep $1,200 in cash in my account. So that's the basics of what an option is. It's a time-sensitive financial instrument that gives your money extra leverage and hitting power on the buying side and lets you hedge your position against risk on the selling side. Of course, assuming that the options that you're selling are actually covered. Next episode, we'll be chatting about implied volatility and the Greeks, which are those forces of extrinsic value. Details of that giveaway I referenced earlier. I'll select 2 people at random from among the people who comment on this video between the date of publication and 2 weeks from then to receive a custom finance data package for 3 months. Tell us what real-time data and streaming you want from our subscription list, and what the hell, I'll throw in our Trader Alerts breakout tool and premium forum pass too. Talk to us about what you thought about the video, how your stock trading is going, why you started investing, something like that. The winner will be announced in a future video, so be sure to subscribe to not miss any of our videos. One person will come from the commentators who are publicly subscribed to the channel, and the other will come from the general list of commenters publicly subscribed and not. It won't require any detailed user information. The winner will just need to sign up on Investors Hub and give me their screen name. So if some clown starts asking for your social security number or password, that's not me. So that's it. Be sure to like, comment, and subscribe so you can get in on that giveaway. Follow us on Twitter at ihub_vision, and I'll see you again soon.